I am so delighted to have Gabor with us today. He is the chair, as you can see, of Foley and Lardner's venture capital practice, but more importantly, he's a very brilliant man who has tolerated a lot trying to get this webinar going, and I thank you so much. Uh, in addition to working with entrepreneurs, Gabor is also chair of the Foley Venture Fund, and he was kind enough to speak to our group last year. I saw a blog post with how much is your company worth, and I asked him if he would kindly let us all know. So, Gabor, I'm going to turn this over to you, and again, I thank you in advance.
You're very welcome, Annette. Thank you, and sorry for all the troubles. Technology should be a lot easier than it seems, but now that we got there, this is really wonderful. Welcome all. Let me just launch right into the presentation, and I guess at the end of the presentation, I'm happy to answer questions. Jeff says he can't hear me. Is that, can you hear me, Annette?
Can folks hear Gabor? I can hear him. Okay, I'm going to have to say that that may be a local problem on one person's computer. So let's go ahead and jump into this, Gabor.
Okay. I have to give me. Are you able to see the whole slide here? I think you can, right?
Yes.
The way that I look at, and the way that I think most people look at the evolution of a startup high growth company is the way that it looks on this particular slide, which is on the bottom you kind of see what the company is doing, and on the top you can see what the company is looking for in terms of financing. So if you think about this, somebody comes up with an idea, it's technology, life sciences, whatever it is, and starts working on the idea, and at that point the only investment that's made in the business is the sweat equity of the founder. At some point, the individual or the group, the founder group that's come up with this idea, decides that it's more than an idea. It actually has some proof of concept. It's actually going to be, it looks like it's going to work. And in order to make it, to show that it's going to work, they need some seed money. So what they typically do is go to their friends and family, or they dip into their own pocket to get some financing. This friends and family round is typically a very early round, consisting of somewhere between $5,000 to a couple $100,000, and that enables them to get to the stage where they have a prototype, a beta, whatever you call it in the particular industry, that can be demonstrated, that's something that has some reality to it. And typically it's that stage when the founders decide they need more capital, and they go to angel investors who are individuals who, I'll come back to why they are interested in doing this, but eventually these are people who will come and invest in this very early stage of the company. The investment from friends and family and the investment from angels is typically done on a convertible note. The reason it's done on a convertible note is very simple. No one has any clue what the company is worth at the time, so they basically punt on valuation. Their view is, who the hell knows what the value of the company is at this stage? But what we want is to make sure that we get that we sort of piggyback on the first valuation that the company is going to have from a professional investor, which is at the next stage, the venture capitalists. But we want to get all the benefits that the venture capitalist is going to get when it invests. But because we are investing earlier, we want to get some additional benefits. So what our convertible note will typically do is have a discount from what the where if a venture capitalist invested $1 a share, our discount is 20%. We're going to invest 80 cents a share, so our note is going to buy us more shares. And sometimes we say we don't really care how much the valuation is that the venture capital investor is going to put on the company. We want to have a cap on the valuation, meaning that the highest valuation that we are willing to accept for our investment is $3 to $5 million, whatever that number is. After the angel financing or somewhere in that same process, there are government grants and loans like SBIRs that various companies can get, loans and grants from the Defense Department. There are various kinds of other industry investments which are what's called non-dilutive in the sense that they're not going to result in some of the stock of the company being issued. These are typically grants that are simply given away. That's an example of what Mass Challenge is doing when it's giving away prizes. It's not taking anything in return. Government grants occasionally take some sort of a limited license in return, but it really doesn't impact significantly the capitalization of the company. By the time that this angel money is burnt up, you are hopefully at a point of first commercial use, at which point you can go to venture capitalists and start looking for money from them. The money from the VCs is typically in the starts in the couple $1 million range and can go up to $50 to $100 million, even for a venture Series A financing. And that financing is typically used for moving from prototype to manufacturing a limited quantity of materials, or getting to the next phase of an FDA process. And then as the company grows, obviously sales, marketing, corporate infrastructure all have to be financed, and you end up a whole series of additional venture financings. And as the company goes from there to an ultimate success story and an ultimate exit, it can go out and go and do joint ventures, do venture debt, which is sort of a blend between equity and debt. Silicon Valley Bank lends you $5 million and takes, in addition to getting an interest rate on its loan, is issuing to you, is getting warrants from the company for a certain percentage of the stock, which essentially means that the bank is getting a combined rate of return between the equity and the stock that is somewhere less than what a venture capitalist would get, but more than what a typical bank would get. But ultimately, you can get commercial loans once you start having revenues. You can pledge your receivables, your inventory, and ultimately you end up with an exit, which is either an IPO or a sale or some in-between financing with other types of lenders like private equity. So that's kind of the way I look at the archetype of a startup growing through from beginning to exit. If you think about valuation, again, I always look at this as a growing pizza pie, and you can use any analogy you want, but I like the pizza analogy. So if you think about the little pizza that the three founders create, that's your sweat equity. And let's say that there are three founders, they all have the same percentage interest. It's obvious, you see the beginnings of value creation. You then add to that the friends and family financing, and you see that the founders are diluted because the orange friends and family slice of the pizza gets about, I would say about 25, 30% of the pie. But if you look at the absolute real estate that each of the founders owns, the amount of value that each founder owns because the valuation has grown as the company has developed more assets, each founder's shares are worth more. If you then go to an angel financing, the angel financing is the purple slice, and while the relative percentage of the founders and the friends and family has shrunk because you've added the angels to the overall capitalization structure, if you measure the amount of real estate, the amount of ownership that the founders have in terms of absolute value, you see that the founders have much greater value after the angel financing than before. And then if you start looking at what happens with the venture capital financing, what you realize is that you have the Series A, which in this particular case, the blue slice is about 25, 30% of the company. You then have the angels, friends and family. What I've done here is assumed something that happens all the time, which is that one of the founders decided that this is not for her or him, and left the company, and some of the shares that that founder has were repurchased by the company for the original purchase price. Then you see on the top a management pool in this sort of light blue-gray color that is also created as a kind of a treasury stock, as a kind of kitty to issue shares or options or restricted stock to people coming into the company who are not founders, but who are very important to the future success of the company, and who are given equity incentives so they have some skin in the game as the company grows. And then as you get further in the growth of the company and you end up with a Series B, a Series C, a Series D, the overall pizza pie becomes much more complex. In addition to the different series of preferred stock, you end up with warrants that might have been given to the lender, as we talked about it, a debt, some sort of a venture debt player. Management in the purple on the bottom are the people who've gotten some of the stock from the equity pool, the management incentive pool. The founders still have a very substantial interest, and then as you get to the final exit, in this case an IPO, the investors may own a majority of the company. These are the Series A, B, C, and D investors and angels. I just didn't want to make the pie into too many very small slices, so they're all kind of lumped in there. The public owns maybe 20-25% of the company, and then everybody else on the left side is still a substantial owner. So that's kind of the global vision that you typically see in these companies. And in order to kind of understand one more important concept, let's talk about what pre-money and post-money valuation is, so that you have a better sense of that piece of the puzzle. So in the first pizza pie, what you see is that the company, before the venture capitalists come in, but after the friends and family financing, and this sort of skips the angels, but the venture capital investors could be considered angels, but in this case they're sort of post the angel round. The founders own 65% of the company, and the company has an $8 million valuation. So at that point, and what does it mean it has an $8 million valuation? It means that an investor, a venture capitalist, comes in and says, I'm willing to give you $6 million on an $8 million pre-money valuation. So before the money comes in, according to the venture capitalist, the company is worth $8 million. The founders own 65%, so they own $5.2 million. Friends and family own 20%, so they own $1.6 million of valuation, and so forth. But keep in mind that as part of this pre-money valuation, the venture capitalists will tell you, well, in order to kind of realize the ultimate value of this company, you need to set aside an equity incentive pool of 15%. What does that mean? Those shares have not been issued to anybody. Those shares are sitting in this, quote, pool, but they're really just a bunch of unissued shares that have been, quote, reserved. And all it means is that when new management people come in, those shares are going to be issued from this pool. Now, the fact that the pool is in the pre-money valuation means that those shares, when they're issued, are not going to dilute the venture investors. They're not going to reduce their percentage interest. They're not. If you really think about this pre-money valuation, that equity pool is kind of a imaginary thing. And basically what it means is that if you didn't have the equity pool, the founders would have a higher percentage. The friends and family would have a higher percentage. And but by putting in this pool, what the venture capital investors are saying is that we want you to dilute yourself by issuing additional shares to management, we're not going to participate in this equity incentive pool that you're setting aside. So that's really a negotiation. Obviously, if that equity incentive pool was only 10%, then the founders would have started out with 67 or 68%, whatever their pro rata share of that 5% that you're reducing the pool by. And then if the equity incentive pool was not enough after the money was raised from the venture capitalists, then additional stock to management would come out of everybody's side, including the venture investors. So that's kind of an important point of this equity incentive pool. That negotiation is important because it really says where do the shares come out that are issued to future employees, future key management people? Does it come out of the hides of only the founders and the friends and family, or does it also come out of the hide of the venture investors? And my suggestion is that you have to come up with a rationale as to what it is, as to why it is that you're setting your pool at 15% or 10% or 5%. And the rationale has to come from how strong is your existing management team, who are the folks you need to hire in the next year, year and a half to make the management team strong enough to be able to run a company with venture financing. You shouldn't set aside enough, so much stock to fund people coming into the company as managers 3 years from now. It should be a window of about a year, year and a half of expectation in terms of additional management hires. Then, of course, you see how the post-money valuation works. With a $14 million valuation, the new investors own 43%, and the founders own 37%. And that's basically the story. Now, let me just talk about one more thing here, because I had this conversation yesterday, and I have this conversation almost every day. If you look at the pizza pie, I always tell my clients, I'd rather have a smaller slice as a percentage of a larger pizza. There is more to eat if I can create a larger pizza, even if I end up with a smaller slice. Now, that's not always the case. It depends on these valuation proportions. But as long as the valuation keeps growing, as long as I can take money that a venture capitalist or an angel investor gives me and grow the company by more than what the immediate valuation is after that money comes in, I will be better off. So this idea of keeping a majority of the company or suffering too much dilution is a question that you can only answer by asking yourself, am I going to be able to grow the pizza larger than what I have to give away of the company to the investors at the moment of this post-money valuation? Now, here's the other piece that I constantly struggle with, and I just want to emphasize. There is no correlation, no connection between your percentage ownership of a company and control. Let me repeat this. There is absolutely no relationship between whether or not you own 51% of the company as the founder and your ability to control the company. Let me give you an example. Facebook. Facebook shares are common shares, and Facebook is obviously, as a public company, only has common shares, but it has two classes of common shares. One class of common shares is the one that's owned by, I'm forgetting his name, but the founder. The other class of common shares are the common shares that are owned by the public. The same thing is true in many companies nowadays, where the founders end up with a much higher percentage interest in terms of voting rights, 10 votes per share, than the public. So here's a situation where founders could own 5% of the company, Mark Zuckerberg may own 20% of the company, but Zuckerberg controls 95% of the votes. So that's a critical piece, a critical example of how this works. How does it work in a private company? The way it works in a private company is there is something called a shareholder agreement. And the shareholder agreement says that a venture investor who might have only 25, 35, 38, 42, whatever percentage of the company has the right under their shareholder agreement and under the terms of the preferred stock that he or she gets to veto certain things. They have the right to appoint a certain number of people to the board. They have a right to vote separately as a class on the issuance of additional shares of stock, on hiring key personnel. You can make these various veto rights very comprehensive or very narrow. So I had this negotiation, mock negotiation, about a month and a half ago at Mass Challenge in Boston in front of a bunch of Mass Challenge incubator companies, and I was negotiating with a good friend of mine who is head of 406 Ventures, which is a big venture fund in Boston. And when I was explaining this thing to them kind of making the point, as I was the company, and I was making the point, look, you know, you have 30% of the votes, so how on what basis are you looking for all these rights to approve a sale, a financing, hiring a new CEO, and so forth and so on? Why should you have that right when you don't own a majority of the company? I own a majority of the company as the founder. And he says, well, it's just that those kinds of issues, we want to have a seat at the table. We want to be able to talk about it. We want to be able to come to a consensus about what it is that you're going to be doing when it comes to a critical transaction. And I said, and by the way, I think there is some truth to that, but there's also something that's much beyond that, because, for example, if they have the right to approve any new financings, they can basically impact, you know, who is going to be financing you, how much the valuation is going to be, and so forth. In any event, so I said to them, well, you know, I hear this argument all the time when we're sitting at a pizza joint discussing what toppings to put on a pizza with the rest of my family. They all just want to be at the table, and they all want to negotiate and discuss what toppings we're going to have on the real pizza. We've all decided how big the pizza to be, so that's not an issue. And of course, the problem is that at the end of the day, even if I'm the guy who is going to write the check, I'm the guy who has the biggest slice of the pizza, I never get an anchovy pizza. I just never get there, even though that's what I would really like, which everybody thought was funny. And at the end of the presentation, for the first time in history, one of the folks from a Mass Challenge company came up to me and delivered to me a small all anchovy pizza, which I then managed to share with the rest of the folks. So talk a little bit about what these different categories of financings are. And a lot of this is sort of stereotypical, and there could be all kinds of exceptions, which I'm happy to talk about. If you go to friends and family, you're typically dealing with folks who are unsophisticated. You're looking at small amounts of dollars being raised. You're looking at a small number of people that you can go to, 1 to 5 investors. And the reason they give you money is because they like you. They want to give you an opportunity. And the only problem that you have in going to them is that, you know, come Christmas or Hanukkah or some other religious holiday coming up there, or Thanksgiving, when you sit around the table, they're all going to ask you when you're going to make them millionaires. And because they're unsophisticated, they really have a very limited idea of how long it takes to get something done, how much challenge it takes, and how much dilution they're going to suffer in future financing. So friends and family are inevitable initial investors, but you have to deal with the fact that, unlike venture capitalists who you would meet at board meetings and a few times in between, friends and family will be sitting around the table and calling you at 2 o'clock in the morning and asking you why you can't pay them back their investment or 2 or 3 times their investment because they want to go to vacation in 2 months. The Jobs Act, this new act that has supposedly made it easier to get money from common people, not accredited investors, has this whole crowdfunding idea is intriguing, but it's and there are various restrictions, but various opportunities in terms of raising money through these crowdfunding websites that have sprung up. My concern about this is that at the end of the day, you're still dealing with the same quality of investors who are best described or best imagined as being friends and family. You're dealing with a bunch of folks who are not sophisticated investors, who by definition are not accredited, meaning they don't have a lot of money and a lot of experience in making investments in high-risk companies. And I would not be surprised if in a year or two or three, you wouldn't see tons and tons of lawsuits where these investors come together in a class action and say that the company they invested in misled them in various ways, even though the SEC regulations require quite a detailed amount of information before companies can crowdsource money from unaccredited investors. Friends and family financing, what do you give them? We talked about the fact that we give them convertible notes so that if they get issued a $100,000 note for their $100,000 investment, when the venture capitalist comes in, they can buy $120,000 or $130,000 worth of investment for their $100,000 note. Typically, these are longer-term notes. I mean, nobody expects them to be paid back because the idea is that they're just a way of punting ultimate valuation. They're convertible at discount, as we talked about it. And it is highly, highly unusual. In fact, I can't think of a single example where those notes were guaranteed by the founders. I've heard of somebody asking for that, but this is really a situation where if the company fails, your money is gone. What rights do they get? They get generally no board seats. Sometimes you create a board of advisors, but typically you don't give them very much rights. Sometimes they will ask for financial reports, and again, just be careful because these are people who don't know how to handle information about the company. The number of times when these folks start to talk to their friends or their bar mates in a bar about the investments they make and give away trade secrets or intellectual property, you got to be careful how much information you give them. But when their notes are converted to stock, they'll end up getting the same rights in terms of information as the venture capitalists. Of course, a lot of these rights, typically when you get preferred stock issued, are tiered. So if you are a large investor, you get more rights, more information, and so forth. When you're a small investor, like a friend and family who converts into preferred stock that's issued to the venture capitalist, you're a small investor, you get lesser rights in terms of information. Angel financing is the next phase. It's a limited group. Typically, the amount that you can raise from individual angels is in the $100,000 to $1 million range. I had a long conversation with one of my colleagues who is the head of the Silicon Valley office and does angel financings on the West Coast. And one of the things that we talked about are super angels. These are people who are putting money into the company in much larger chunks, in chunks of $1 million to $5 million to even $10 million. And they can do it because, as my colleague told me, is that the realizations, the exits, the amount of money that is realized by founders and key employees of companies in Silicon Valley seem to be much more. So if you're a founder in one of these California companies, you could be realizing $100 million, $200, $300 million if you sell your Facebook stock or your Square stock, and then you have more money to put into startups. If you only made $10 million on the East Coast in selling your company, the percentage that you're going to dedicate to angel financing is smaller, so each of your investments is smaller. So super angels is more of a West Coast phenomenon, partly because there are bigger exits in the West Coast than on the East Coast. why do people invest money as angels? And who are those people? My experience is, and this is why it's so difficult to help my clients find angel financing sources, is because my experience is that angels are a large group of people. So you have to go to a large group of people who are segmented by interests that represent their own experience. So if I am a life science founder who made a ton of money in selling my life science company, I will typically invest in other life science companies. So just to give you two examples, I do this seminar once every month at an accelerator called Lab Central in Kendall Square called the Wizards of Life Science. And I spoke to Josh Boger, who started Vertex. I spoke to Harry Termeer, who started Genzyme, and they're both angel investors. And I asked them, why are you investing and what in companies, and what kind of companies do you invest in? And they talked to me about the fact that they invest in companies that they get passionate about, and they're typically life science companies in areas that they care about. Josh cares about blindness. He invested in a company aimed to cure blindness. Henry Termeer had a guy show up in his house from Sweden with a particular invention in a particular therapeutic, and he somehow collared Henry and talked to him about how his daughter is very ill, and he retired from his job and has been pushing to develop this technology. And Henry's imagination started to flare up, and he's backing this company. So it's all about people passionate about a particular technology and understanding the technology, wanting to participate in the evolution of the technology that sort of started from where they started, and those are the people typically who invest. And then, of course, you have professional angel funds such as Common Angels, where angels come together and they typically put some money into an organization that vets deals, where they come together once a month and listen to pitches by different companies, and then either they put money into the fund that invests in these companies at an early stage, and then they can invest alongside the fund, or in a less organized group, they just invest individually. They make individual decisions based on the recommendations of the professional team that vets these companies before they come before this group. Again, the motivations are vicarious participation in new enterprise. They understand the space, but they're obviously looking for substantial return on their investment. Typically, angels are looking at putting money in convertible notes. They often will require some rights. Board seats are often demanded by angels putting a significant number of dollars in. They want more information about the company. And again, they will receive the same rights as the venture founders, the venture capitalists, when their note is converted to preferred stock. People talk about the risk that the venture capitalists, when they come in, will say, well, geez, these angels came in at an earlier time. They have they can convert at a discount, and we're not willing to do this. We're not willing to accept that. If you want us to put money in, the angels have to give up some rights. They have to give up some economics. That used to happen more when the economy was in a downturn. I think VCs now generally respect the fact that they're not capable of funding companies at this early stage where the companies are looking for $500,000 to $1 million, and cram downs, which used to be popular in 2009, 2010, today are almost unheard of. Where do you find your angels? It's all about networking. It's something that is very hard, frankly, for intermediaries to find. Certainly bankers, lawyers, accountants may know one or two people, maybe they may know a half a dozen people who are in a particular industry. But in order to really generate a sufficient core of angel supporters, you have to think about what are the industry groups that have the largest concentration of people within your industry, where those people have already made enough money that they would be interested in starting to reinvest their money in new companies. Or you go to these professional angel groups like Common Angels, Hub Angels. There's dozens of them, and and try to raise money there. It's certainly helpful to have warm introductions, but it's definitely a challenge, and it's definitely an area where, like in every other aspect of venture investing, where if you are a successful entrepreneur who has done well in his first company, looking for money in your second or third company, and you're going back to the same people who financed you the first time, it's much easier to get your second or third round of financing. Venture capital financing. I need to talk a little bit about what a venture fund is all about, because I realize that a lot of my clients think that, these are a bunch of financial types, they're a bunch of vultures who are just trying to make as much money for themselves as possible, and they're really a pain to deal with, and they're arrogant and obnoxious, and they would rather not be dealing with venture capital people. So you got to understand, and they're afraid that in 5 years they're going to say goodbye to you and force you to go public or to sell, and then in the meantime you're lucky if they let you continue to run your company because they want to bring in their friends to run the company, and you'll be out on your backside 2 years or a year after the money is put in. All of those fears have some basis, but in order to understand some of the basis of these, you have to start thinking about who are the people who create these funds, and where does the money come from. It's always helpful to know where the money is coming from. And the money is coming from you and me. When you and me put a bunch of our salaries into retirement plans, whether it's Fidelity or your corporate retirement plan, you are putting money into a bunch of pension funds. And when you're putting money into pension funds, those pension funds need to earn a certain return in order to be able to pay out to you and me when we retire the promised or expected monthly retirement benefit. Now, these pension funds invest 89 to 95% of their money that's sitting in their treasury in stocks and bonds, and they get they get almost nothing in bonds now. They get a return that depends obviously on the stock market on their stock portfolio, but basically they invest money like you and me in stocks and bonds that return a relatively low percentage of their capital. In the meantime, more and more people in these pension funds are ready to retire. The demographics of our generation suggest that more and more people are retiring, and they need more return. So what do? They look for what's called alternative investments, which are investments which produce higher rates of return. Those are real estate, those are hedge funds, and those are venture funds and private equity funds. And those funds have higher risk, but they also have higher return. Those returns could be anywhere from 10 to 30, 35%. So how do they pick these funds? These funds are picked based on their historical return. So if you are in the top quartile of returns among all the venture funds in the U.S. and internationally, all these pension funds are going to be swarming and begging to allow money to be put into your venture fund because you're in the top quartile of performance. If you're in the bottom quartile, nobody's going to invest in you. if you're a brand new fund and have never invested and don't have any record, it's going to be very hard for a pension fund to invest in you, because how are they going to know how you are going to perform? Now, if you were a manager of a highly successful fund and you quit and you start your own fund, you can show them how you did as when you were in your prior fund. So that's your track record. But this is why these funds are striving to increase their return as much as possible and are looking for returns in the 35 to 45% range per year, so that they could attract money from pension funds. Now, of course, everybody knows that when they invest in, say, 10 companies, 2 of them are going to be total dogs, or 3, and they're going to go bankrupt. 3 or 4 of them are going to survive and do reasonably well, and 1 or 2 of them might become unicorns, might become, widely successful, and it's those 2 or 3 of them that are widely successful that are going to be able to support this, 25 to 35, 40% compounded rate of return that is expected of the top tier venture funds. So in order for them to feel justified in investing in a company and generate an average return of 30, 35%, they have to believe that each company is capable of generating returns in the 100, 150, 200% range minimum, because they'll know that they're going to be imperfect in making these decisions, and some of these companies will go bankrupt. So that's one piece of it. The second piece of it is, how do these people get compensated, the people who run these venture funds? Basically what happens is that they get 2 kinds of compensation. One is called a management fee, which is basically a relatively small amount of money that they get every year that's coming out of the invested capital that they get from the pension funds. And that is enough to run their operations and pay their mortgage. It's not a lot of money. That is the management fee. It's typically 2% of the amount of capital raised by the fund. So if you have a $200 million fund, you get $2 million a year as the manager, and typically you need to pay for rent, for overhead, for salaries, and $2 million is not a huge amount of money when you think about it. And if you think there's a $10 million fund or a $20 million fund, which a lot of these micro funds are now at that level, say a $20 million fund, you're making $200,000, maybe $400,000, 2% of that $20 million, and that's not a huge amount of money to run a fund on. On the other hand, and this is what it's all about, you also get what's called a carried interest, which is typically 20%. What is that carried interest? It is the once you turn to the investors, the pension funds, all the money they put in, plus, which includes, by the way, you didn't invest all that money because some of it was used up for management fees. But once you return to them all the money they put in, sometimes including a 5% per year sort of interest factor, the rest of the money is split 80%, the rest of the money, which is not profits, is split 80% to the investors and 20% to the managers. So if you're a successful fund, you can make an enormous amount of money. And that's the incentive that drives people to become managers. The other piece of it is that these pension funds are putting money into a venture fund, but they want the money back because they got to pay their retirees. So the expectation is that they put the money in on day one, and 10 to 12 years later, they will have realized all of their investment plus all of their return. So the life cycle of a typical venture fund is 10 years. The money comes in at the beginning. Typically, it's drawn over time, but it's sort of committed at the very beginning. They put it to work. They invest in companies for the first 3 to 5 years of the life of the venture fund. And then in the second 5 years, they harvest it by selling the stock, public offering, or in an M&A transaction. So they are definitely looking at a 10-year lifespan. Maybe it's extended to 11, 12 years in certain cases. But you have to ask when you're talking to a venture fund, what stage are they in? Are they in the 5th year of their operation, in which case your life cycle with them before they want to sell the investment that they're just making in you is going to be shorter than if they're a brand new fund that's going to have 10 years before they need to harvest their investment. But you have to buy into the fact that these partners of yours are not for a lifetime. They are for a defined period that matches the desires of the pension funds that give them the money. So that's kind of part of the game you got to think about. And there are obviously different funds that invest in different stages. So if you if an early stage fund wants to exit after because it's got to pay back the money to its investors, it can find a middle stage fund, a fund that is a mezzanine fund or a private equity fund that invests in companies at that middle stage. So it doesn't necessarily mean that you have to sell your interest as a founder. All it means is that you will have to think about another financing round that will enable your initial investors to exit and get a new set of investors into your company to take you to the next level. How to find and contact. I think this is really a significant issue and one that I always get a little frustrated by. How do you get these venture capitalists? The answer is, I know all the venture capitalists on the East Coast. My colleagues know all the venture capitalists on the West Coast. But I don't have the time, and I think the same thing is true of a lot of other folks who are sort of professionals helping early stage companies find investors. I am very happy and I'm very interested in introducing my clients to venture capitalists because that way I'm doing a favor for both the client and for the venture capitalist friend that I have. But I don't have enough time and I don't have enough knowledge to know who to introduce my startup company to at a particular fund. You know, General Catalyst, 406 Ventures, Matrix Partners, they all have half a dozen to dozens of partners, and each of them is focused on a particular area. The best introduction is when I can find a partner in a particular venture fund who is knowledgeable about and is interested in making an investment in a company within a particular sector. It's up to the company that's looking for the investment to do the research and find not the fund, but the people in the fund looking for the right investments. And that way, and figure out what's the best way to get them excited about this whole process and get them excited about the company. Once that happens, the introductions become much easier and much more likely to be successful. What do venture capitalists provide? They obviously give you money, but they also give you an enormous amount of expertise and experience in putting you in touch with people in the industry looking for a job as a CFO, as a chief medical officer or whatever. And they also provide contacts with potential joint venturers. So good venture capitalists do really add value beyond their money. And it's very important when you evaluate what venture capitalist you're going to go with to talk to the other portfolio companies that they have invested in, talk to those managers, those founders to understand how the venture fund has supported them. You should do as much due diligence as about the fund as they do about you. Ego, you know, everybody has an ego. People who have money seem to have more ego than people who don't have money. Not necessarily true, but sometimes true. The answer is you should really look at the personality of the individual who is going to be sitting on your board as a representative of the venture fund in order to understand whether or not that person is going to be compatible with you and is going to be a good partner, a good marriage partner, because this is as much a marriage as one in civil life. Let's talk a second about preferred stock. Everybody says, venture capitalists will tell you that they want to be aligned with the founders, but truly aligned, because what you are getting in exchange, you are giving in exchange for the money you get from a special class of stock. You, as the founder, have common stock. You are giving them preferred stock, And preferred stock has all kinds of special rights that you don't have. The first right is that if the company doesn't do well, or if the company is ever sold or whatever, even if they do well, the first monies would go to pay off the investors who have preferred stock. Now, let's say that you raised $5 million of preferred stock, and the company sold for $8 million. The first $1 million will go to the preferred stockholders, and then the preferred stock also has what's called an accrued dividend, say 5, 6, 7%. So the next money is also going to go to the preferred stockholders for their accrued dividend. They may only own, quote, 25% of the company. But under this scenario, if you get $8 million for your company, the first $5 million plus the accrued dividend, may say another $2 million, will go to them, and you'll get only $1 million, even though you own more than half of the company. What happens if the company is sold for $50 million? Well, the holders of preferred stock have an option. They can either keep the preferred stock and get the first dollars, or they can convert into common stock. That's what it means to have 25% of the company. So they convert into 25% of the company. And if you sell the company for $100 million, instead of getting the $5 million plus the $2 million of interest or dividends, they convert to 25% of the company, and they get $25 million. So you can have they sort of have their cake and eat it too, in a way that you as a common shareholder don't have that right. Now, what happens if you have another financing and it's at a lower valuation than what they put in? They have something called convertible protection, which means that they are actually going to be able to get more shares, a higher percentage of the company, based on an anti-dilution formula that gives them more shares if they convert in what's called a down round, when the next round is at a lower valuation. They have various governance rights. Typically, they can elect directors. They can have various veto powers. Those are the protective rights. And they have these various exit rights where they can approve whether or not this is the right time and the right valuation at which to sell the company. So they have all these special rights. I have had some clients who are serial entrepreneurs who said, I want my investors to invest in common stock. That's the same thing that I have. And once in a while, they've been successful in doing it, but frankly, that's very unusual. Now, one thing you should remember, and I'll stop here and answer questions, one thing that you should remember about preferred stock versus common is that the good news about issuing preferred stock to the investors is that because they are getting stock that has all these special rights, economic rights, control rights, that stock is worth a lot more in the eyes of the IRS and in the eyes of anybody who thinks about it than the common stock that you hold. So if you want to issue stock options or restricted stock to new employees after a venture financing, typically the per share price that the venture financing was done at, say it was done at $1 a share for preferred stock, you can issue common stock at a much lower valuation because what you're issuing isn't worth as much as the preferred stock, even though when you talk to potential employees, key managers, you kind of equate the two types of securities, and you say that if the investors just did a Series A round and invested $10 million for 25% of the company, that the company is actually worth 4 times as much, $40 million, even though it really isn't, because the common stock isn't worth as much as the preferred stock. It's kind of a fiction that everybody kind of buys into. So that's my story, and I'm sticking by it, and I'm happy to answer any questions. First question: how does crowdfunding investment get? Annette, am I to answer the questions?
Yes, I'm just
under here.
Yeah, just be my guest. I'm just laughing because with all the crowdfunding being so new, And now with the equity crowdfunding, with the passing of the Jobs Act and the SEC publishing guidelines and rules, it's an important question. And I think it's a really important question for young entrepreneurs who just think it's money coming in and don't worry about it.
So, crowdfunding. One of them is the stuff that you see at Kickstarter and Indiegogo, which is crowdfunding where you're putting money when you're buying, or you're basically pledging money to try to support somebody coming in. You're not getting any stock, you're not getting any equity. The most you're going to get, depending on what it says on the website of Kickstarter, is the product that is under development. But in a sense, it's kind of like being an angel, because you will only buy that, you will only fund that kind of a product if you're excited about it. I mean, I, for example, put money into to a new carry-on suitcase that has big wheels and is very cool and is very light, because I travel all the time and nobody seems to make a carry-on suitcase that's worth the money that I have to pay for it. The most I'm going to get, if they're successful, and they raised $3 million, by the way, so they are successful, is a suitcase. So that's, but it's a way of funding in advance the development of a product. So I mean, it is kind of like angel financing, because these people ended up being able to use my money and everybody else's money to develop this product, and then they're giving the product to the people who put in the money. So that money, if you ask about how it's accounted for in the equity structure, it's accounted for. It's not equity, but if you look at a balance sheet, it is essentially prepaid. It's a prepayment for a purchase, right? That's the most that it is. I bet you that it's actually accounted for as a gift or something, as a grant, because you don't have an obligation to do anything other than, if you're successful, to hopefully deliver the product. The equity crowdfunding, which is the new thing that's been generated by the Jobs Act, is actually much more complicated than you think it is. You have to put together a fair amount of information, a very substantial amount of information to your potential investors. You have to go through an accredited, SEC accredited broker website that screens this information and that processes all of these equity funding sources. And typically, you are issuing stock, whether it's common stock or preferred stock, to the people who are funding you, and it's essentially a version of angel investing. There are different requirements for issuances or offers of $1 million or less, or $1 million and more. We can spend a lot of time talking about it. I have a white paper on it. But the bottom line is that it is a securities offering. You can be sued if you don't tell the truth, or if you omit to tell the truth. There's a lot of paperwork, and it's a lot of process, and frankly, it's a lot of work. And my prediction is that in 2 or 3 years, you're going to have thousands of lawsuits brought because of the inaccuracy of that information. So it's not something I'm terribly excited about doing, although I think the Kickstarter stuff is better, and I'm certainly very supportive of it. What type of startups? I'm sorry, go ahead.
I was just going to say, I know before the SEC published its rules, there was some concern about keeping a clean cap table with the crowdfunding. And the bottom line was that before anybody takes in any crowdfunding funds, they should speak to their accountant and to their attorney to get things structured properly so they don't back into a buzzsaw a year from now.
That is absolutely right. So the next question I got is, what type of startups do angel and venture capitalists typically avoid? The answer is that, venture capitalists want to invest in companies that have a promise of high growth, very high growth, explosive growth. So companies that can have that kind of growth are typically companies where there's an amount of investment that's necessary, but once that investment is made, the company's growth is quite organic. So if you think about some successful companies, think about Airbnb or Uber or a software company that has a software product. Once that product is developed, the expansion that's financed by the venture capitalist can be dramatic. If you're a service company, which is what you're talking about, the only way you expand is by adding more heads, more people. And the VCs and angels typically feel that a service company doesn't have a prospect of high rate of growth because it is a service company, because you can only grow by adding people. Now, that's why a lot of service companies that are looking for venture capital will try to productize what they do. They will say, look, we're a service company today because that's the way that we are introducing our product and understanding the market. But once we get to scale, we can take our product and we can take our service and turn it into a product that we can sell with minimal amount of labor. So we won't have to constantly use the money of the VCs to grow the labor force and kind of continue on this kind of person-to-person struggle for new business. We're going to be able to sell this on the web. We are going to be able to support it minimally with human beings. It's all going to be done automatically, and suddenly you've converted a service company into a product company, and that's much easier to finance.
Gabor, before you address the next question, I can stay online as long as anybody needs to be online, but can I distribute your presentation to people in the PDF format? Okay.
Absolutely.
And offline.
I have about 5-10 minutes more because of the delay to continue to ask questions.
Okay, that's fine. And I'll make sure that everybody has your direct contact information as well, your email, so if they have additional questions, they can reach you.
Yes. Okay, let me just answer first Steve Cohen's question. The answer is that the question is, VCs don't like to see a lot of small uneducated investors before they invest. That is absolutely true. And the reason is that uneducated investors, and this is the problem of crowdfunding, are a pain in the neck. You need to raise more money. You have to get their consent. You have to get them to sign pieces of paper. You have large numbers of investors out there if you have crowdfunding sources that you have to chase down. They don't understand how long they have to wait until they get their money back. They don't understand why you need to raise more money and dilute their interest. So there is a definite bias, not only by venture capitalists against small uneducated investors, but by yours truly and lawyers, because we frankly are the ones who have to take a lot of the heat from the small investors when we do a next round of financing for the company through a venture round. So the fear and bias is well founded. The horror stories that I can tell you about angel investors who are not sophisticated about this are countless, and I'll just leave it at that. Phil, Bob Hoopsher asked about the typical multiples that are being paid by public companies for strategic acquisitions. That depends on the industry. If you look at your company, you gotta look at your comparables in the same industry. You got to look at comparables that are similarly sized in terms of revenues and profits, even comparables in the same geographic area. So I would say that, in my experience, kind of a company that is not that is sort of medium growth. You could sort of an industrial company or a manufacturing company or a service company. You can see multiples today in the 7 to 10 range, but in companies that are very high growth, software companies that have a huge rate, potentially huge rate of growth, or are very strategic to an acquirer, you can see multiples in the 20-30% 30x range, and these are all multiples of earnings before interest, taxes, depreciation, and amortization. But you can also see companies that are being purchased at 3-4 times their total revenues, depending on the industry. So it really is very industry specific, and you got to look at comparables. Phil Adams asked about the how much is your company worth. To be very honest with you, I have never been able. I've taken plenty of business courses, and I know all the different valuation methodologies, discounted cash flow, comparables, book value, liquidation value. The answer is that in the early stage of a company, it is very, very difficult to come up with a scientific basis of valuation. What venture capitalists do is they will look at a discounted cash flow model. They will look at what comparable companies are in the space and what valuation other venture capitalists have put onto those companies. But I can tell you that two companies that could be in a very, very similar space could be worth diametrically different amounts, depending on such things as whether the founders are first-time entrepreneurs or serial entrepreneurs doing their fifth company. And it's not about the technology. It's primarily about, well, it's partly about the technology, but more importantly, it's about the management team and their track record. And, you know, what is a hot sector? You know, some sectors today are very hot, and even though there are dozens and dozens of companies jumping into the sector, such as security or you know, information security or IoT, some sectors are hot and the valuations are much higher.
Okay. Well, Gabor, I know that you have to leave.
I'll go ahead.
Go ahead. I was to say I know that.
So one more question that Steve Cohen asked. I'll quickly answer. I agree with Steve that the trend today appears to be buyouts rather than public offerings. In general, at a lower valuation than IPOs. That's just because right now the market is not so hot for IPOs. But let me tell you something. If a company goes public and it has a bunch of venture investors, they're not going to be able to sell immediately, even though the valuation may be higher. They have to sit with the company at least for 180 days after the public offering. That is a standard lockup that is required by the underwriters. But beyond that, if you sell too quickly and too soon, the market will perceive that as a lack of confidence in the company, and the stock starts going down. So venture capitalists will either distribute the shares to their pension fund investors and then recognize what the value is at that point and mark that up as their realization, and then or they'll sell slowly. So, you know, an IPO is not the final exit. It's just another step in the capitalization of the company, and it's definitely fraught with continuing risk by the investors. So an outright merger or acquisition is not such a bad outcome, and often is preferable for everybody.
Gabor, thank you so very, very much. Tremendous amount of information. I will touch bases with you later on about the video, and I want to thank everybody for coming today. I will continue to schedule webinars and hope to see you online again.